Hi, I'm Dave Turner of Turner Barratt Corporate Finance, and this is one of a series of videos that I am making on how to buy a business. In this video, we are considering the differences between buying assets or buying shares. If the business that you are trying to buy is a sole trader or a partnership, then you will need to buy the assets of the business from the proprietor. If the business that you're trying to buy is structured as a limited company, then there are two different ways in which a purchase can be effected. Either you can buy the shares of the company, or you can buy the trade and assets of the company and leave the seller holding the shares of what will then be an empty shell company. Which route you take will have implications for the risks you're assuming, and therefore the amount of due diligence that you will wish to undertake, and also for the tax treatment for the seller. If you buy the shares of the company, then all of the rights of the company and all of the liabilities come with them. So, for instance, if the company has not paid its business rates for a number of years and has a large liability to the local council, that liability will transfer with the shares. For this reason, you will need to be sure that you conduct sufficient investigatory work, due diligence, to try to identify any problems that you will be inheriting. If, on the other hand, you purchase the trade and assets, then the purchase agreement will specify which assets and which liabilities you are acquiring, and, to use the example above, if the rates liability is not included in the list of liabilities to be transferred, because it was not known about, it will remain a liability of the company and not transfer to you. It is clear, therefore, that as purchaser you would prefer to buy the trade and assets rather than the shares, since the risks to you are less. The tax treatment for the seller under the two different routes will produce very different outcomes. If the seller, Mr. X, sells the shares in the business to you, then he is liable to capital gains tax on the gain produced from selling the shares. This is likely to be covered by entrepreneur's relief, so that his tax bill will be fairly low or nil. If Mr. X sells the trade and assets of the business to you, then the seller is the company, Y Limited, and it will pay corporation tax on the capital gains it makes by selling its trade and assets. The sale proceeds are held by the company, and in order to get them into Mr. X's hands, they must be paid to him by a dividend on which he will pay income tax. The company is not entitled to the entrepreneur's relief. In most cases, the tax treatment is significantly more favourable for the seller if he sells the shares to you rather than the business and assets. This is usually so significant that the seller will not entertain any other possibility. So despite the fact that you as purchaser would prefer to buy the assets, in practice you will probably have to accept that you must buy the shares because otherwise the seller will not sell. If, however, you are buying a subsidiary company, then the owner will be the holding company and entrepreneur relief will not apply. It may then be possible to structure the purchase as assets rather than shares. For further information, visit our website. Thank you.